Oh, happy Tuesday and maybe government shutdown eve. Welcome everyone to our fourth quarter 2025 and full year 2026 preliminary global outlook webinar. My name is Winnie Cisar and I have the honor of leading the CreditSights global strategy team. Today, coming after a mostly buoyant third quarter, we have another strategy-filled webinar featuring Zach Griffiths, U.S. Head of Macro and IG Strategy, Logan Miller, our Head of Euro Strategy, Regis Chatellier, Head of EM Sovereign Strategy, and Zerlina Zeng, Head of Asia Strategy. We have all been very hard at work on our final forecast for 2025 and our preliminary outlooks for 2026, which I'm not going to lie, was a head-spinning endeavor. Forecasting feels in a lot of ways much more difficult than historically. Seems that equities just go up and credit spreads just grind tighter, although maybe today we're getting a little bit of risk off. Now, given that we have 1 hour and 5 panelists, we'll be going through the highlights of our outlooks. As always, if you have a question, please go ahead and submit it through the Q&A function, and we will do our best to address as many as we can. Also, today marks the last day of our 25th anniversary celebrations. Anyone who submits a question will be in the running to win some of our 25th anniversary swag. That includes golf balls. Those were our fan favorites at our event in New York a couple of weeks ago, socks, which Zach was rocking yesterday, and of course, other goodies. We also have the emojis going. These are always a fun addition to the webinar. Keep them coming in, but be kind to the strategy team. We have been working hard this year, this past few months to stay on top of the very wild mix of headlines and market action. Now, with that, as we like to do on the strategy team, we're going to turn the tables and ask the audience our first question. So our first audience polling question is, in your opinion, the Fed is behind the curve, they need to start easing ASAP, well positioned to wait and see, or not restrictive enough, inflation is coming back? Now, of course, the Fed did recommence its easing cycle very recently at its Fed September meeting with a 25 basis point rate cut, and notably only one dissent, with Stephen Myron saying that they should have cut by 50 basis points, perhaps a little bit surprising after we had a couple of Fed governors dissenting at the July meeting, calling for bigger, or at least starting rate cuts then. All right, let's go ahead and get these questions all tallied up. We're almost to about half of the audience, which is usually the milestone I try to get to. All right, let's see what the audience has to say. All right, well positioned to wait and see. This is a little bit surprising to me. So Zach, let's start with your views on the outlook for macro and rates in the US. We have the audience saying that the Fed is well positioned to wait and see, and maybe that's because we've had some very mixed messages from data, and pending this US government shutdown, we might be flying a bit blind if key labor market and inflation data are not released. How have your thoughts on the US economy evolved since our first half of 2026 outlook webinar in July? And are you more concerned about a weak labor market or reacceleration in inflation?
Thanks, Winnie, and thank you all for joining. I remember we asked this question last time. I think the answers were pretty similar, very heavily weighted to well-positioned to wait and see. And when I go back and think about what we were seeing in the economy back in mid-July when we did our second half of 2025 outlook, the clearest shift has been in the labor market. So back then, we had just gotten the June report that showed an upside surprise on jobs with 147,000. The unemployment rate had unexpectedly fallen to 4.1% versus expectations for an uptick to 4.3%. Now, since then, I think everyone on this call probably knows the labor market has weakened significantly, at least the data have weakened significantly, with job gains falling to a 3-month moving average of just 22,000 jobs. And that June report itself was revised to a negative print of 13,000 from that initially released 147,000. The unemployment rate is now 4.3%, not terribly high historically, but up 80 basis points or so from the recent trough. So I'd say we've grown more concerned about the labor market, and that's kind of informed our Fed call that we'll get into in a little bit more detail. And I'd say the first chart on the left here looked a lot better in terms of the argument for slowing growth and a worsening labor market. prior to the revisions that we just got. We had about 2 consecutive quarters of this real GDP x net exports and inventory change, which have been even more volatile than they typically are given some of the policy coming out of Washington. But we did have a big upward revision there. So I think the key is data is difficult to parse through right now. I think some of the policy initiatives have caused some big shifts in activity and some big shifts in these more volatile components, which make it more difficult to identify a trend. But I'd say 2.4% real GDP x those volatile figures is certainly not sign for concern now, but this is the second quarter that we're talking about, and we're not too concerned about where we were months ago. We're concerned about where we're going. And if we look at some of the underlying trends, you can see in this middle chart, in particular, transportation services and recreational services in real terms, so taking that personal income and spending monthly measure and adjusting for the PCE deflator component, show some pretty negative trends in terms of some of these more discretionary categories. And it's interesting, I think the macro data have overall held up quite well, but we are seeing signs of slowing underlying the consumer, and that's what we've heard from our analyst team for a while now. We do think that that becomes a bigger market driver going forward, particularly into 2026. And I'd highlight on the right, just looking at the manufacturing sector, which has been challenged throughout. We're not expecting the pace of easing that we have priced in or expected in our base case forecast to really be a huge boost to the manufacturing sector. You can see employment really among some of the lowest levels in terms of that particular survey over the past 20 years. The overall ISM manufacturing index remains in contractionary territory. We did get a bump of new orders in the August data, but we'll get a release of that this week. So we'll kind of get another update. But we are a little bit more concerned about a weaker labor market, a more flimsy consumer, and that leading to a more clear slowing in the growth trend in the U.S., Winnie, going forward.
Thanks, Zach. That's great. I mean, it sounds overall like the US economy is in this kind of weird, almost stuck point, right? Like nothing is so bad to be decisive, but also finding those sources of incremental growth and incremental momentum, it seems harder to come by at this point. So as you're thinking about that as your base case, how are you thinking about the path of Fed policy and rates through year end? And then how are we thinking about 2026? Is this just another year of what we've seen the past couple of years where the terminal rate stays kind of the same, but the time to get to that terminal rate just gets pushed out another 12 months?
I think we're kind of reaching a point where the rubber's meeting the road here, Winnie. And so just to lay out our expectations for the remainder of this year, we have one more rate cut as our base case. I think the market is priced for a little bit of a coin flip between one or two more. I think obviously we're very focused on the labor market, but it's pretty clear to us as well that the inflation data will not allow the Fed to move as much in terms of easing policy as they would otherwise like to if they were able to just focus on the labor market. Unfortunately, they don't have that luxury. And with that backdrop, we have the Fed easing another 100 basis points in 2026 to take the policy rate to around 3%, just looking at the upper end of the Fed funds target range. And so that's a little bit more than what we have priced into the SOFR futures market. As you can see here, it troughs around 3.1% at the end of 2026. And I'd say where the big difference in our call is in market pricing is we think the Fed could be easing even further from there as this weakening labor market and a flimsy consumer create this backdrop where inflation is eventually coming down and the Fed is taking the policy rate to a lower terminal level than what the market is priced for. And as you can see here, the market is priced for us to hit that 3.1% and reverse course. So it's really going to come down to that dichotomy between the labor market and inflation. On net, we are more concerned about the labor market, and that's kind of what's driving our expectation for more easing in 2026 and perhaps into 2027. The summary of economic projections has the policy rate remaining at about 3 1/8 through 2028, and that's above the Fed's estimate of neutral. We think they're likely going to have to get through neutral with kind of the overall labor market weakness and how we expect the consumer to respond to that. And so that's kind of where we differ clearly from the market right now, at least where market pricing is. In terms of our overall Fed call and thinking about how the balance sheet picture fits into what we're expecting for rates, We are expecting the Fed to end its quantitative tightening program. As you can see on the far right chart here, we are starting to see some signs of stress in funding markets, even though it seems like there's liquidity pretty much everywhere else in the market. There are some signs there that suggest to us, especially if the Fed is kind of looking to take its foot off the brake pedal, I suppose, in terms of having restrictive policy. I think they start to end QT, and that creates a bid for treasuries. And so quickly, just where we think rates are at the end of this year and where they go in 2026. We have the 10-year not really doing a whole lot between now and year end, ending at around 4.25, let's say, as we think there are still concerns on the fiscal side, on the inflation side that could keep upward pressure, while labor market concerns and expectations for lower rates really throughout the curve. And we have the 2s10s curve finishing the year at 75 basis points, eventually steepening further to 100 basis points by year end 26, with the 10-year moving to 3.5% and that 2-year at around 2.5%, kind of indicating that with Fed funds at 3%, perhaps the market is priced for a move even lower, still looking at that 2-year point on the curve. So we're looking for a bull steepening of the curve going forward. We ultimately think that some of these growth dynamics, inflation coming down, this labor market weakness we're talking about, ultimately becomes a bigger driver of what we're seeing in the markets than some of these fiscal concerns that we've seen throughout this year. And I think it's interesting if you kind of zoom out and think about what's been going on across the globe, how curves have responded. I think the US 10-year, looking at a subset of G10 sovereign markets, is the only one that has actually fallen year to date. And so while there is a lot of concern about the US, it does seem to be kind of the place for global investors looking for safety still. And that dynamic really hasn't shifted yet, Winnie.
Yeah, those are all really interesting points. And you guys did put together a couple of really fascinating reports, first on the performance of sovereigns across G10, and then also looking at the owners of the US Treasury market and also the US corporate market, and what would presumably happen to yields and credit spreads if we saw a big deceleration or kind of rotation away from USD assets by non-US investors, which of course was very topical at the beginning of the year in April around Liberation Day. And I think that some of the conclusions you came to with actually Treasury yields could come down and credit spreads could widen out are a bit contrarian to what clients have been thinking in the, oh, credit spreads will go negative and Treasury yields will gap higher, which has never been our MO. I think this is a great place to bring in Logan to start to talk about the European markets. Logan, the ECB has shifted its messaging lately, and the market is now pricing in a steady policy rate through 2026. This kind of blew my mind yesterday when I was looking at it. What economic factors are at play here? And do you have any key areas of differentiation relative to our US expectations? Is Europe, set to outperform economically?
Yeah, that's right, Winnie. Yeah, I think it's interesting if you look back historically, the ECB's rarely kept rates kind of in this neutral 2% area for extended period of time. And you're right that the kind of the rate futures market's definitely pricing in kind of a steady pause over the next 12 months. I think right now the market is definitely grappling with a sort of mix between what economists are thinking about growth expectations and what sort of the rate futures market is really sort of pricing in here. But I do have to give credit to sort of the ECB thus far. We'll start with that in terms of sort of taking a proactive approach to kind of stabilizing growth without also stoking inflation. I think if the ECB hadn't been cutting rates pretty aggressively over the last 12, 15 months or so, I think we'd be looking at much more pronounced growth impact from tariffs and probably a much weaker credit market fundamentally. That said, I think it's fair to say that since we published our outlook in July, I think we've gotten a bit more constructive on the growth outlook for Europe. For one, we've not seen the disinflation pressures caused by tariffs and a stronger euro that were initially kind of feared that would be the case. Europe is certainly, I think, not out of the woods when it comes to navigating global trade challenges, but the trade deal between the EU and the US was certainly promising in terms of at least staving off the worst case scenario for trade. So I think that's caused a big kind of repricing of ECB expectations. I do think fast forward from a year from now, the sort of the positive impact from fiscal stimulus, recalibration to tariffs, and inflation that still kind of persist above that 2% kind of long-term neutral level might actually cause a rethink in ECB expectations. So going into next year, I actually think that the EC might actually need to start shifting back towards a more hawkish policy and actually begin tightening policy once again at the end of 2026. Officially, if we're going to have a 25 basis point rate hike priced into Q4 of next year. And really, the way we're thinking about this is it's all about sort of the newfound fiscal spending impulse across Europe, particularly out of Germany, but actually really broad-based for that matter when it comes to defense spend. That's really a major shift from what we've seen in recent years around trying to reindustrialize the European economy. With that comes job creation, more competition from European suppliers, and credit expansion without the need to keep rates at low levels. So, I think the latter point around credit growth is probably the most important for this call. We've seen an increased willingness and even strong appetite from global credit investors to put money back to work in Europe. In some way, that's effectively doing the ECB's job for them by providing companies with sort of a wider range or deeper pool of liquidity, which certainly is helping sort of with investment needs and also helping companies to extend their sort of debt maturity runways. So that's all constructive. I think it does mean, probably a convergence between Europe and U.S. rates next year. Now, I don't necessarily think that Europe can grow alone without the U.S. And if we do start to see some of those weaker factors come into play in terms of stuff that Zach outlined, it's probably not going to bode well for Europe. But I do think, nonetheless, the trajectory is what matters the most. And I think, Europe seems to be pointing in the right direction, at least from sort of a longer-term growth perspective. So the takeaway here is that we do think the ECB is going to sort of take a wait-and-see approach over the next couple of quarters. But again, I think we're going to start to see more convergence between the ECB and Fed sort towards the second half of next year. So the other thing I just mentioned is that Europe is coming off a lower base, both in terms of interest rates, but also growth that's been much weaker than the U.S. So again, I think if you get that sort of convergence in policy rates as well as growth rates, that will certainly mean probably a shift towards a more hawkish stance and more kind of higher long-term rate story, which we'll get into when we talk about sort of our forecast table for next year.
Yeah, those are all great points. I mean, if you look at ECFC for 2026, Eurozone real GDP is forecasted at 1.1%, which is not too shabby, and US at 1.8%. So definitely a kind of compression in the delta between those two regions is kind of the base case forecast, at least from economists right now. So Regis, on the EM side of things, as we think about developed markets really driving some incremental fiscal spending lately and operating at fiscal deficits that look a little bit closer to EM levels, are EM fundamentals objectively better than developed markets at this point? What is your base case fundamental view for EM sovereigns in 2026? And how are you thinking about the regions and countries that we should be most focused on right now?
Thank you, Winnie. Yeah, so regarding the fiscal situation in EM, I would say yes. Emerging markets now look much more disciplined than in developed economies. I would mention two reasons for this. Basically, emerging markets have learned from the past that it's not really a good idea to run large deficits for a long time. That's inflationary, and eventually you need to face high debt costs and eroding market confidence. And the second reason is IMF that has been imposing for a long time now fiscal discipline as a pre-requirement for financial support. So I would say emerging markets didn't have much choice. I mean, they had to stick to stricter fiscal discipline when for developed markets, it was a bit of a free lunch in a way. Today, if you look at the average fiscal deficit in EM, it's around 4.4% of GDP. But if you look at primary deficits, meaning that you remove the debt service, the average primary fiscal deficit is around 1% of GDP. For the sake of comparison, in the Eurozone, the average is 1.5% deficit, primary deficit, and in France, we're talking about 5.5%. Even Germany has more than 2% primary deficit. In the UK, it's around 2%, and outside Europe, Japan, it's around 2.5%, and of course, US is around 6.5% or so, and that's including debt service, right? So, objectively, if you look at primary debts, primary fiscal deficit, it's actually much better. Going forward, you could see some EM countries with fiscal slippage. For example, Indonesia, they have been increasing social spending, but in fact, fiscal deficits are likely to remain much lower than in developed markets. In the case of high-yield countries like Brazil or even like Egypt, it's not so much a problem of primary balance or fiscal discipline. It's more a problem of high inflation and debt service cost. So yes, the answer is yes. It's more EM is more disciplined. There's one exception, and it's a big one. It's China. Primary deficit is around 7% of GDP, but China is China, and they have quite a lot of resources, I would say, and FX reserve. I guess they can leverage on. Now, regarding other fundamentals, of course, there is growth. EM growth prospects remains significantly better than in developed markets. And with high growth, you have also more sustainable debt. GDP growth is expected to average something like 3.6% in EM next year. That is excluding China, because if you include China, it's around 4.2%. And the gap with developed economies is going to widen even more than in the past. One last thing I would mention, EM central bank have become more credible, implementing more efficient policies to tackle inflation. Even desperate cases like Turkey, in a way, like, they have turned quite hawkish at last. So they have become much more efficient in this respect. And as a result of this, and you're talking about fundamentals, we've seen a stream of rating upgrades since 2023. And that reflects stronger fundamentals. The average rating in EM is about the same as pre-COVID level. Regarding your second question, and what is my base case for fundamentals, I would say that growth is likely to weaken in the second half of 25, or meaning until the end of the year, and probably most likely early next year, because of US tariffs, of course, but also lower demand from developed economies affecting commodities, essentially. As I said earlier, growth is likely to rebound around 3.6% in 26 later on, because I would expect global trade to be redistributed across EM, and with more focused on regional trade. However, I would expect less rating upgrades going forward, simply because a lot has been already factored in. Asia continue to do well, most likely. Middle East as well. The increased oil production that helps obviously GDP. Even countries like North Africa, countries like Morocco, Nigeria, Egypt is doing quite well. The picture is more mixed in Latin America, especially in Mexico and growth, and Brazil, where situation is a bit more complicated. Situation is also a bit complicated in Eastern Europe, where because of the reliance on exports to Western Europe, and Western Europe being affected by tariffs and slow growth overall. My only caveat, I would say, as far as EM fundamentals are concerned, are FX reserves. They're not rising as fast as we would like to see them rising. But apart from that, fundamentals are pretty sound across EM.
Great. Thanks, Regis. It is really interesting to see how EM fundamentals have hung in a lot better than I think a lot of people would have anticipated. And also EM from a performance perspective has done really, really well. Now, on that point, we have our next audience question, which is that market performance has generally surprised to the upside this year, with credit spreads grinding tighter and U.S. equities making new highs. With many pointing to strong technicals as the reason for lofty valuations this year, what do you expect to drive markets in 2026? Will we continue to see these strong technicals / cash on the sidelines? improving fundamentals, disinflation, and productivity gains, or weakening fundamentals, rising downgrades, and defaults. Now, while we have the audience going ahead and voting on their preferred answer, we do have a couple of audience questions. Zach, I'm going to start with you. We have kind of two questions that are focused on U.S. macro. The first is, can the top 10% of U.S. consumers carry consumer spending in 2026? That's definitely been a dynamic that we've seen in the past, year or so. And then also, what do demographic trends in the U.S. tell you about prospects for U.S. debt, treasuries, growth, and inflation?
So starting with that first one, Winnie, I'd say we're expecting the top 10% to no longer be able to carry the whole economy. And maybe that takes a little bit of froth coming off of the equity markets or asset valuations across a variety of asset classes. We would have thought that some of the policy mix coming out of the U.S. this year would have been to dent risk sentiment, and so far it hasn't. So I think we're expecting that dynamic to shift at least a little bit over the next 12 months. If it doesn't, we'll have to rethink our outlook and kind of what that means for spreads in the economy. And in terms of the demographics, I think there are still some demographics that support kind of lower growth and I sort of feel like in the near term, it's going to come down more to what the Fed is doing, what the economic backdrop looks like, and then from there, what we'll have a better understanding of kind of how the economy or demand for U.S. dollar assets can kind of absorb a downshift in growth as we've had such remarkable economic growth for the past 3 years.
It really has been remarkable on the consumer side for the past few years. And I think your point around some of the air coming out of different asset classes might be required to see that downshift in that top 10% consumer. Equities, of course, is a big one. I think some of the recent consumer confidence data actually pointed to people who have significant allocations to equities have been the most confident this year, which makes a ton of sense. And then we also need to be looking at the housing market because it's been interesting to see some deceleration in pricing momentum in different regions. Michael O'Brien, our home builders analyst, has been a little bit more cautious. And the big question of, what mortgage rate really gets things going again from a housing perspective, I think is really important, especially heading into next year. All right, with that, let's see what the audience says. Okay, so over 50% of the audience thinks that weakening fundamentals with rising downgrades and defaults is going to be the big driver of markets. Second to that is strong technicals, and then improving fundamentals, disinflation, and productivity gains is last on the list. I find this interesting because most conversations I have with clients, people just point to strong technicals and cash on the sidelines as really what has underpinned everything and why things cannot, move wider in terms of credit markets. So, Zach, let's start with some updated views on U.S. investment grade corporate credit. If we are thinking about long end treasury yields coming down a bit, getting more constructive on duration, what should IG corporate portfolio managers do? Is there a distinction between those who are focused on total returns and then those with excess return mandates?
Yes, a big distinction here, Winnie. I'd say we're comfortable extending out the curve even to the very long end for total return focused investors, as we think yields ultimately come down quite a bit, offsetting some of the spread widening that we're anticipating. The yield curve has steepened across many segments recently, creating a more attractive proposition to move out the curve, again, particularly for yield buyers. And when we think about a slowing growth dynamic, it is a bull steepening of the curve. And I think even if you go out to the 30-year point, we could see yields moving lower in a way that produces solid price returns as well. On an excess return basis, we'd prefer to stay up in quality and shorter in duration. I'd say maybe the 3 to 5 year point seems like a bit of a sweet spot for excess return focused investors on the spread curve. And we still like single A's in corporates and financials. That's kind of a view we've held for a while.
Right. And then as you're thinking about IG, if we're less constructive on an excess return basis, where would you say, all right, go ahead, let's be buying IG again if we get to whatever spread level. What is that spread target for you?
Historically, we've used our probability weighted forecast, and you can see on the slide here, we have 105 basis points when we kind of look at our vector of scenarios that we kind of lay out. I think I'd want to see maybe something in the 105 to 120. So 120 basis points is our base case for year end 26, and our labor pains base case, as you can kind of see there. I already went through what we're expecting from a rates perspective. And of course, it's going to depend on what is going on with the underlying economic and credit market fundamentals. I think if what we're envisioning, where the Fed is able to take the policy rate a fair bit lower and maybe moving to something like 120 basis points, is not really a stop on a much wider move, then I think that's kind of where we would shift to at least a market weight and potentially overweight allocation. If we are seeing a further deteriorating of fundamentals, then perhaps we could be heading to that 150 basis point bear case scenario, in which case we would not necessarily use that as a threshold to move into the more constructive camp. And so I think there's going to be a lot of underlying cross currents to monitor, but I'd say in that 105 to 120 range, again, depending on the big drivers of what has gotten us there and where we think we're going. That kind of seems like a reasonable range to start thinking maybe we're being appropriately compensated for credit risk.
Imagine that, feeling appropriately compensated for credit risk. That would be a change of pace after the past couple of years. On the US high yield side of things, it really has been all about the technicals, as we've seen more mixed performance across fundamentals, across sectors, and across rating cohorts. Now, we always say that supply follows demand, and after a few consecutive months of very robust inflows after the April sell-off, new issue supply has stepped up. We have September on track to be the busiest September on record, topping 50 billion, and new deal announcements, including the 55 billion record-setting LBO of Electronic Arts. If you haven't seen, Hunter Martin has been covering that story closely, and it includes 20 billion of committed debt financing and a 6 times leveraged sticker. So expect some high yield net new issue supply coming our way. Now, like I said, on our first half 2026 preliminary outlook call in mid-July, we cannot argue with the technicals. I do not want to underestimate them, underappreciate them. High yield has benefited from being a generally shrinking class and one that is higher quality than in historic cycles. And then we have robust retail inflows plus defensive positioning, allowing for very strong performance. Now, I do want to point out, though, that the strong performance is not evenly distributed across the market on a spread basis. One would think that in this environment, triple Cs would be outperforming, but in fact, year-to-date high yield double Bs are 15 basis points tighter, while triple Cs are 52 basis points wider, putting total returns for double Bs slightly ahead of triple Cs and also ahead of single Bs. As we think through fundamentals next year, we have concerns that lower rated issuers will continue to face pressure from untenable refinancing costs, while the ratings upgrade cycle is definitely stalling out or potentially even reversing. Our prospective fallen angel issuer list now has 6 issuers with 26.2 billion of debt outstanding. That doesn't include some of the others that get talked about a lot, the Boeings of the world, the Fords of the world, and are, ones that our analysts have a bit higher conviction view of being downgraded over the next 12 months. And that 26.2 billion is more than double our rising star total volume. Plus, we have to factor in that net new issue supply from the pickup in deal activity. And then finally, Chaz Johnston, our energy analyst, released his 2026 price deck for oil and natural gas yesterday, and he has oil moving down to $55 per barrel. Now, he also points out that high yield energy E&Ps are much more natural gas exposed, and he has a more constructive price target for natural gas. But the reality is, every time we see oil slip below $60 per barrel, high yield energy spreads gap out. And that is definitely something we need to keep in mind. Now, while our high yield fair value model actually points to slightly tighter spreads than current levels, we find it difficult to expect that spreads will remain at these tight levels if some of those macro and micro erosion factors that we expect really begin to play through. Our official high yield default forecast for 2026 is a pretty moderate 3.5% to 4%. Now, that's a step up from recent levels, but still at the low end of historic ranges. We also worry that optimism around rate cuts and lower rates will be met up with a step up in new issue supply, just as fundamental momentum stalls out. This leaves us more constructive on higher rated market segments with a focus on catalyst driven trades, and we do prefer the high yield market to broadly syndicated loans. Now, within broadly syndicated loans, we reiterate our underweight allocation as we see both fundamental and technical headwinds looming. While near-term maturities for the BSL market are pretty much non-existent, we're seeing some increases in net new issue supply as some M&A, LBOs, and equity recaps come back into the market. Our expectations for labor market weakness and a decline in base rates really caps loan returns in our base case forecast, and loans have already lagged high yield since we downgraded loans to underweight earlier in the year. Our probability weighted total return forecast for the broadly syndicated loan market in 2026 is 4.7%. Now that is more than 100 basis points lower than our probability weighted high yield returns at 5.8%, and also well behind USIG at 6.3%. So on that kind of risk adjusted basis, broadly syndicated loans seem like they are in a little bit of a tricky situation. All right, with that, we'd love to hear from you. Which US asset class do you expect to generate the strongest total return performance over the next 12 months? Is it cash, long-dated treasuries, 10 years or longer duration, US investment grade, US high yield, US broadly syndicated loans, US mortgages, or gold? Gold's been on a tear. I know that's not really a US asset class, but we had to ask it. Everyone can go ahead and vote. And while people are voting, Zach, I'm going to throw a question to you from the audience, and that is, how exposed is credit to an equity repricing if the current AI optimism overestimates the development and we get more negative headlines? Who would be less exposed within Euro IG, USIG, Euro high yield, or US high yield? Do you have any thoughts on that?
Thanks, Winnie. It's an interesting one. We did some analysis back, I guess it was in January. Was that DeepSeek? And it does seem like there is probably more exposure in the U.S. in terms of kind of what has been driving lofty asset valuations across a variety of asset classes. I think this is something that we can probably dig back into in a little bit more detail, but it's definitely a big concern of ours and something that seems to have been in the headlines for maybe about a week, and then we had the new administration come in, tariffs took over, and a variety of other things. And so I think this will be an interesting one to kind of dig back into and get a sense of. If anything, talking to some of our other analysts on the tech side, it seems like the DeepSeek revelation has only gotten more potent in terms of confirming its ability to do some of this training at much lower levels. So I think the U.S. is probably most exposed in terms of overall valuations, but this is something that I think we're going to add to our list to follow up on now that perhaps some of the macro backdrop is becoming a little clearer going forward.
Those are all really great points. I was reading yesterday that we've seen a massive increase in new ETFs this year, and a lot of these are leveraged ETFs focused on some of the AI trades. And so that does make me a little bit nervous that some of the maybe hidden leverage in the system is some of these leveraged equity ETFs. All right, let's go ahead and see what the audience is thinking about total return performance next year. And wow, this is all over the map. But gold comes out as maybe not the clear favorite, but a clearer favorite at 25% of the audience thinks that gold is going to continue to just rocket higher. Following that is US high yield. Then we have long-dated treasuries, US investment grade, and then mortgages, and then loans and cash kind of at the bottom of the list. So I think that this is a really interesting distribution and maybe highlights just how difficult asset allocation is right now overall. All right, Logan, Euro, IG, and high yield markets, they're trading in line with US on a spread basis, and that really marks a pretty significant re-rack from the trends that we've seen over the past few years as Europe traded persistently wide to the US. Do you think that these valuations are justified? Is there potential for Europe to trade through the US on a sustained basis?
Yeah, thanks, Winnie. I do think like if gold outperforms next year, I think Europe can actually do quite well versus U.S. assets in that case. But no, I think in general, it's been obviously a global collapse in credit risk premium so far this year. It's not been kind of Europe alone. It's really been kind of broad based. And Regis just talked about EM, and there's really what I think it comes down to is just ultra strong technicals, and for Europe specifically, this kind of newfound perceived defensiveness of the asset class. I think there's a couple of things really driving that. One is obviously the German fiscal spending pivot that we saw earlier this year, which is leading to improved growth prospects over the next several years, coming off of I'd say very weak levels of kind of economic output over the last few years. Number two has been just the cashing up of corporates, and that's really helping companies preserve their balance sheets. And then the third kind of main thing driver for Europe this year has been, I think, a lot of the noise and policy changes that we're seeing in the U.S. are actually both indirectly and directly helping Europe in terms of sort of becoming more of a safe haven and more steady asset class to be invested in. So I think that's keeping valuations in check. I thought the point about AI was quite interesting. The question we got from the investor. I do think one of the reasons we saw this earlier this year, but really we've seen kind of more limited exposure to some of the high flying and re-leveraging sectors such as tech when it comes to AI, the AI boom within Europe. So maybe perhaps it's not great for European equities if that trade sort of continues, but I'd argue it actually is quite favorable for credit if we do start to see sort of a backup in tech valuations on the U.S. side. We definitely saw that earlier this year when it came to sort of the DeepSeek situation. So again, yeah, I think some of the kind of key things that I laid out there, I would say the caveat is that outside of sort of Germany in particular, the growth outlook still remains, I think, quite subdued. I do continue to sort of worry about the challenged political landscape and some of the worsening fiscal health situations that we're seeing when it comes to countries like France. So when we're thinking about next year, I really do think it's going to be 2026 is really going to be a kind of a prove it year for both Europe's economy as a whole, but also for credit spreads, considering how tight levels are today. Now, when it comes to kind of our forecasts, I think directionally we're really in very much the same camp as you and Zach are when it comes to spreads in the U.S. We do see fair value at wider levels from today. That being said, we definitely have taken down our sort of longer term, fair value targets for next year when it comes to Euro credit. We look for IG to end the year now at 100 basis points by the end of 2026. We were initially expecting to see it back up more towards kind of that 130 area. So definitely, I'd say trying to convey a bit more of a positive longer term outlook for Europe. High yields, same thing. We have spreads going out to 350 basis points by the end of next year in our base case scenario. So definitely, I'd say a bit less cautious than we were coming into this year in terms of really kind of more pronounced spread widening. But nonetheless, I think if you look at just where things are today, it's really hard to argue that spread should move much tighter from here. The second question I think you asked me was about the potential for Europe to trade through U.S. on a sustained basis. I think the answer is yes. One, I think we don't see the same degree of intentional releveraging in Europe that we're seeing in the U.S. when it comes to sort of M&A and AI spend. Like I mentioned, the second thing is that with tariffs kind of firmly in place, many companies in Europe are squarely focused on balance sheet management, which is great for credit quality in general. And then sort of the third thing is that Europe is arguably much more sensitive to short-term rates. We've seen the ECB cutting rates over the last 18 months. It definitely helps both corporates and sort of consumers from a fundamental standpoint. So yeah, I think definitely next year we could see this kind of continued sort of outperformance at the margin. We are keeping with our underweight on Euro IG. Really, that comes down to limited excess return upside. We have kind of 25 basis points of excess return baked into our forecast for next year, and total returns that are likely to come down pretty meaningfully from the last couple of years. We're looking for sort of a 1.5% total return next year, driven by kind of a continued steepening of the yield curve, the Boone curve, which puts pressure on on prices. Where that actually may help is Euro high yield. We still have a favorable view on Europe on high yield market. We've kept our sort of market weight recommendation, looking for again spreads to move a bit wider, but that's not always bad for total returns, and looking for sort of a mid single digit return year for high yield next year.
Yeah, really interesting takeaways around Europe. So it seems like if you're excess return mandated, still looking at Euro investment grade perhaps makes some sense. All right, Regis, another thing that we've seen is pretty significant compression of EM sovereigns relative to US investment grade and high yield. You've pointed out some pretty stretched valuations, both in aggregate and then highlighting some of the single countries that you're a bit more concerned about. How do you think investors should be thinking about the recent strength in the market? Should they be selling into that, recalibrating risk exposure, or is EM just set to continue to perform really well?
Yeah, Winnie, I just wanted to rebound just briefly on gold performance this year. Very strong, but I would simply say EM is also part of the equation. We have a lot of EM that have been buying gold. Central banks have been buying gold, and China has been buying massively. You have a lot of central banks, like including Turkey, having a lot of reserves on gold. And it's part maybe of a move like gold moving away a bit more from the dollar. So it may not be the end of the gold rally. I'm not especially in gold, but what I can see is central banks are part of the equation. Now, as far as emerging markets concerned, yes, indeed, emerging markets have outperformed pretty much all fixed income assets this year. Sovereign IGs have returned something like 9.1% year to date. That's thanks to lower core yield. You probably know that 10-year Treasury is compressed around 45 basis points, but also because of tighter spreads at around 40 basis points. So the performance is split between the two. There's also a longer average duration of EMIG, and it's actually longer than the rest of credit asset classes. That has contributed to the outperformance. If you look at sovereign high yield, the performance has been also quite robust, plus 10%, nearly 10% this year. Spread compression has been quite modest. I mean, relative to the level of spreads are compressed by 20 basis points or so, which is not much, but half the performance has been driven by carry. Carry is still quite decent. Now, how we can explain the spread compression this year? Obviously, bullish sentiment has been key. Global volatility has remained quite low, and that has boosted risk appetite. But also because of improved fundamentals. This year, we had something like 26 emerging markets that have been upgraded by the major rating agencies, and we've seen only seven downgrades. So that suggests that, or that clearly indicates that credit fundamentals have improved. And that explains the spread compression. So in a way you can justify. Now, spread valuations are very tight, if not extremely tight. In EMIG, sovereign spreads are the tightest level since 2007. In EM high yields, it's a bit less the case. Spreads are tight, but that's because of the recent sell-off in Argentina that has pushed EM high yield to a bit wider. And Argentina has a big weight in the high yield index, so that explains why spreads have moved higher. But if you exclude Argentina, EM high yield spreads are also very tight. To be honest, EM fundamentals are sound, as I said, with the caveat that I would like to see a bit more stronger FX reserve to be really on the safe side. But my main concern is spreads. Spreads are too tight, given the quite elevated geopolitical risk. Domestic political risk are still significant. Slowing global growth, obviously rising US tariffs, deteriorating terms of trades, and pretty or relatively large fiscal deficits. They are not as wide as developed markets, but it's still quite significant. And even if you're on the bullish side, you say everything is fine, and you consider only global financial conditions, based on historical patterns, spreads should be at least 60 basis points wider from current levels. So I wouldn't buy this market just yet. Down the road, I would expect EM high yield and EM high G to widen to 400 basis points from 280 currently. That's quite wide. And I would say I would stay quite defensive on the position, favoring like really improving stories like Morocco, Turkey, and countries like Chile down the road with elections that could boost the credit profile. That's basically the call.
Super helpful, Regis. So we have a couple of follow-ups from the audience on EM. And first is actually on gold. So if the price of gold has been driven by central banks who are not price-sensitive buyers, do you see that stopping anytime soon? How are you thinking about that?
I don't know. To be honest, I think if U.S. policy continue to be quite difficult to predict, and then I think it's a geopolitical question. If U.S. is confrontational with emerging markets, then there will be an incentive to shift away a bit from the dollar just to avoid sanctions. In a way, you've seen a bit of a move with euro issuance in some countries, like, for example, Colombia. Colombia is not really the darling of Donald Trump right now, so they have been issuing in euro quite in size recently, basically not to, and rebuying dollar debt. So that's basically to avoid being exposed to sanctions or being less dependent on U.S. investment. The same happened with gold, and China, central bank in China buying gold. And in the past, countries like Turkey, this has been also the same sort of strategy. So I would say it's a political, I would say, issue, but everything being equal, I would say right now, I don't think gold rally will stop just yet.
All right, if the gold rally is not going to stop just yet, something to definitely keep in mind. The other question for you, Regis, is if the U.S. economy catches a cold, let's say that U.S. economic growth decelerates even more than what we're expecting, how likely will EM catch the flu? How tied are U.S. and EM economic performance outlooks at this point?
Well, I would say there's a macro response and the market response. Macro response is if U.S. is slowing down significantly, actually, it will have an impact on EM, but not so much. Actually, the power engine of EM is essentially China now, and you have a lot of other trades. You have also the willingness of Europe to open and closing deals with Latin America. So I guess there will be alternatives for EM to grow. They can also continue to cut rates to the extent, at least for some countries, to boost growth. So there's some room for maneuver. And as I said before, stimulus has been quite modest. I mean, on the fiscal side, EM has been more responsible. So U.S. slowing down is a problem, but not too much, not as much as in the past. China is more the power engine for EM exports. But there is the market impact. EM could be impacted if US slows down significantly and there is a significant risk off. Then obviously EM would be impacted, but I would say would be reflected in EM spreads. Is it a bad thing per se? Probably not. In my view, as long as EM credit fundamentals remain relatively sound, it wouldn't be necessarily a bad thing just to balance a bit more the risk reward.
Awesome. Thank you, Regis. All right, Zerlina, if we think that US and Europe and EM sovereign valuations are tight, Asia dollar IG and high yield are at razor thin levels with even tighter spreads. Is there any value left in these markets? And how have local currency corporates fared in Asia this year?
Yeah, thanks, Winnie. So despite U.S. tariff and some political instability, the Asia dollar credit markets has been quite remarkably resilient this year on the back of benign macro backdrop, sound corporate credit fundamentals, and net negative new supply. So Asia IG now trades 15 bips tighter than US IG compared to 30 bips wider historically, and Asia high yield is 8 basis points tighter compared to historically 40 basis point wider than US high yield. So I think the risk reward of Asia IG for excess return focused investors is quite poor at the moment with such stretched valuation. But the majority of Asia credit investors are actually yield buyers, so they focus on total returns. And our base case looks at close to 7% for Asia IG in 2026 still. And Asia IG yields have dropped 70 basis points in 2025, but are still very decent around the long-term medium levels. And with US 10-year yields still likely hover above 4%, for the rest of 2025, we see valuing adding duration and locking yield of some of the high-grade Asia IG papers, including dollar bonds from off-index positions in Japan and Australia. Last week, we wrote about the switch trades we like in Asia credits, such as moving to names with similar or better credit quality while earning spread and yield pickup. These include some of the switching out of overbought Pan-Asia insurers to off-index positions in Japanese lifers, rotating from tightly traded Chinese privately owned enterprises such as China Tech with all these AI things to Chinese state-owned enterprise hybrids, and allocating to long-dated Middle East quasis with steeper curves from some of the Asian peers. Also finding short-dated carry in bank capital instruments with limited call risk. We are more selective in Asia high yield as spreads of high quality papers are priced to perfection and all-in yields have fallen much below long-term mediums. For Asian local currency bonds, since last year, we have recommended investors to diversify into this space, given the very strong technicals. So inflow into Asia local currency bond markets this year was more than 20% of the start of year AUM, because of the improved breadth and trading liquidity of selected currencies like Australian dollar, CNH, and Sing dollar. We still quite like Australian bonds, which offer good spread pickup and high quality names for choices. And the yield of the Australian dollar bond curve is also steeper, quite a plus for duration buyers. Sing dollar new issues are popular given the strong secondary performance on the back of the demand from local insurance and banks, and yields after cross-currency swap for selected Sing dollar bonds are actually higher than comparable dollar ones. CNH has received very strong inflow from Chinese account after China has loosened some of the cross-border investment controls, and performance should be supported by stabilizing China rates from here. The appreciation of Australian dollar and Sing dollar also helped markets to return over 10% year to date for unhedged investors. So this is still space we see a lot of value for diversification purpose.
Thanks, Zerlina. So we have a question from the audience asking if we could ask you about the credit quality in the high yield market. I know that Asia high yield, the big story was China property for a couple of years. That seems to have really faded. And now with Asia high yield spreads tight to US high yield spreads, is credit quality in the Asia high yield market really that much better now?
I would say in the double B space, the credit quality has improved quite a bit because of the very good local funding conditions. And as Regis also mentioned, in the EM space, a lot of the Asian central banks they have been starting their easing cycle and probably will continue to do so. That boosted local funding conditions. All these high yield players, instead of issuing high cost dollar debt, they are going to the local currency market, getting bank loans or issue local currency bonds. So that helped them a lot. But I would say in the triple C space, it still have some high yield China property developers, and these trading are quite driven by headlines. If we look at the China property markets, there's a still very prolonged downturn. We are not seeing any emergent sign of sustained recovery. All these developers, they are not generating new cash internally or getting new money from the loan or bond market. So I think the resolution of the bad debt will take very long time. If we look at the Southeast Asian high yield corporates, markets, I think overall funding conditions has improved, but here and there is some liability management going on, especially coming to the Hong Kong property space. I think there are still some idiosyncratic credit risks have not been entirely resolved. We also did some Asia high yield fundamental monitoring. I think in terms of net and gross leverage, it is coming down still, but it has deteriorated quite a bit for single B and triple C. And if we look at interest coverage, this is also coming down from the peak levels because of the quite high USD funding cost. Into 2026, I think similar to US high yield, the credit fundamental will likely deteriorate, and some of the triple C and single B will go through liability management with the terms quite uncertain because of the uncertainty of getting new money. So I think it might drive spreads wider into in some of the pockets of the market.
All right, thank you, Zerlina. I really appreciate that kind of thoughtful deep dive into Asia high yield. All right, we have one question for the audience here, which is, what is your preferred region for total return performance in 2026? Are we looking at the US, Europe, EM sovereigns, or Asia corporates as the best place for total returns in 2026? And while we let the audience vote, we're going to do a very quick speed round because I would love to hear from the team what their biggest lesson learned in 2025 is. I think that there are a lot of things to reflect on from market and macro action this year. Zach, let's start with you. What's your biggest lesson learned in 2025?
I wrote down about 5, but I'm just going to go with don't fight the technical.
Love it. Don't fight the technical. You heard it here first and last. All right, Regis, what is your biggest lesson learned in 2025?
2 lessons, basically. The market is fundamentally changed. It's not only politically, but because of ETF and e-flows and passive investment, that has made the market less sensitive to economic changes and political developments. That probably brings some inertia to trends, and that's a bit of a worry to me. The second lesson is market doesn't really care about fiscal deficit anymore, or much less than in the past, and that can cause some problems down the road.
Those are great lessons learned for sure. Zerlina, what is your biggest lesson learned this year?
I think it is be aware of consensus trade. For instance, India renewable, very hot trade start of the year, but some of the names didn't work out because of relative value and corporate governance. China rates onshore CGB also very hot at the start of the year, but because of the bond to equity rotation, China rates really didn't do well so far in the past couple of months. Another one is Taiwanese lifers. These are the first comers to the dollar bond market because of rarity. A lot of investors are chasing them, but in the middle of the year, because of FX appreciation and hedging related issues, these bonds really widen a lot. So I think in Asia credits, trades are still very consensus, and a lot of positions are very crowded. So I think investors should be aware of those trades.
Yeah, that's a great point, is being aware of where the exits are crowded, because then it's really hard to unwind sometimes. Logan, what's your biggest lesson learned in 2025?
Yeah, so mine is the ability of companies to adapt balance sheets, shift supply chains, and then find alternative financing sources when they need to muddle through.
Yeah, that's a great one. I think a big lesson learned this year. And also something you have to keep in mind is, the delta between the big corporate issuers who have that ability and then the small and medium-sized enterprises that make up a good chunk of employment in the US and also globally, and whether they have as much flexibility. My lesson learned is that a liquidity hangover takes an awful lot to cure. We have seen so much liquidity injected into the global financial system over the past 5+ years. And I think the points that Regis made around just how the market is fundamentally different with ETFs and passive investing, and then add on all of that liquidity that was injected in, things could continue to be a bit frothy for quite some time. All right, let's see what our audience thinks about preferred region. All right. I suspect that we have a US aligned audience on the phone today, on the call today. So we do have US at the top of the heap, followed by Europe, EM sovereigns, and Asia corporates. We do have one final question for the audience today. We always like to wind it down with some caution. So what do you think is the biggest risk facing markets in the next 12 months? Reacceleration in global inflation, labor market unwind / consumer doom loop, AI bubble burst, geopolitical escalations, loss of US institutional credibility, or something else, which we would love to see in the Q&A box if you drop it in there. As the audience is voting, Zach, we have one last question from the audience that is somewhat related to this, and that is, what is your estimate regarding the actual pass-through rate of tariffs imposed by the US? And do you think it is more like a one-time increase in inflation, dare I say transitory, as a consequence?
So 2 quick answers. I'd say I think that from what we've learned so far, there's probably more of the cost getting divided by 3 partners: the exporter itself, the importer, and the consumer. And I think we probably weighted a little bit too heavily our expectations for it to go more to the consumer and perhaps to the importer. And we generally have been concerned about tariffs being a more prolonged inflationary pressure as it kind of trickles its way through the system in various ways. I think that still remains to be seen, but it's definitely a concern that we keep in the back of our head and is a big driver of why we expect the Fed to have to move very gradually to address what seems to be a quite weak labor market when it otherwise might be looking to move more quickly.
All right, super helpful. And let's see what the biggest risk that our audience identifies. And that is the labor market unwind / consumer doom loop. I guess that we have convinced people of our kind of base case expectation. And then we have a tie between reacceleration and global inflation. That's actually our bear case scenario, which we think would be very challenging for markets overall. And then the AI bubble burst. Apparently geopolitical, US institutional credibility, not major concerns for people. All right, now with that, we have made it through the world of credit in just over an hour. We're going to wind down the webinar. As always, thank you so much for joining our discussion today. We love to hear from clients, so if you have additional questions, please reach out directly to any one of us or your sales representative. Best of luck to everyone in the last quarter of 2025. Before we know it, 2026 will be upon us. And with that, we will wrap up our webinar.